Welcome to Stock Talks with Akash. Follow this channel to create a money mindset.
Hey, hi there. Welcome back to my channel. And today we'll be discussing all about enterprise value. So, after watching this video, you will be able to tell what is enterprise value, how it is different from market capitalization, and how to interpret it and how to calculate it. So, let's get started. So, what is enterprise value? Theoretically speaking, it is the value that you have to pay to buy that company entirely. Okay, so how is it different from market capitalization? In market capitalization, what do? You pay for each and every share and you buy all of that. However, when you buy a company, its debt is also yours. So you have to pay that too. That is added in the enterprise value. And once the company is yours, of course, the cash and cash equivalents that the company has is also yours. So that is deducted from the total cost. And that is what the enterprise value is. So, how is it calculated? Let's see. So, what we have discussed, it is the takeover price. Takeover. Now, let's see how it is calculated. So, to calculate it, you have to buy all the shares, which is market cap. Now you have to also pay all the debts that the company has, and that includes short term debt and, of course, the long term debt, minus the cash and cash equivalents. And there are two optional things. If the owner of the company or the promoter of the company has issued some preferred shares, then you have to buy that too. So you have to pay the price for that too. So preferred shares, it is optional either way, because majority of the company does not issue a preferred share. PREFE, preferred share. Let's go over here. Wait, plus the minority share. So minority share is a part of equity that the company does not own. Okay, that's a bit of tricky topic, and we'll discuss it later. Okay, so just to understand, we will focus on these three things first. Okay, ignore for now. These three are major. Okay, market cap plus the minus cash. So that is nothing but enterprise value. If the company has issued preferred shares, then it would be included. If the company has invested in some kind of subsidiary, then the minority shares is also a part of enterprise value. And let's just first calculate it. So let's just go to the browser and then over here. Okay, let's use screener today. Screener.in. Let's just enter. And today, let's see, we'll take the example of Suzlon. And Suzlon Energy. Okay. So the enterprise value is actually directly given over here. It's 85,000 crores approximately. And let's see how can we calculate it manually. Okay, so what I have told you, we will just take a calculator, or let's say Excel file for that matter. Let's take an Excel file, a new Excel workbook. So first we have what we have to take: market cap, right? We can directly get it from here, no need to calculate it. Let's just get it from here. Market cap, very fast. Now what do we need? We need the debt. Okay, let's go to, from where will you get the debt? Of course from the balance sheet. Okay, borrowing section. Now we need what? Short-term debt and long-term debt. What is short-term debt? 129 crores. Let's just add it over here. 129. What is oh, okay, it was long. Now it is short. Short. HORT. Debt. Long-term debt. Let's say long. Now let's see how much is the cash and cash equivalent, and let's see where it is. Let's scroll down. If you remember, we have talked about preferred shares over here. You could see the preference capital. That's, by the way, it's zero over here, so no need. It would be, we were focusing on cash. I think it would be over. Yeah, over here. Cash equivalents. Let's just take this. What was that? This was cash. Okay, so how do we calculate it? We just need to add market capitalization plus long-term debt, short-term debt, and minus cash. Let's just enter. It's 85,640. And let's see what is the value that was given. 85,681. It's approximately near about the same. It fluctuates because of the share price, and it's very, very, very minimum. Okay, let's see how much it has fluctuated. Okay, six, just a 40 crore. That's okay. So now I hope you get to know that how it is calculated and what does it tells you. Enterprise value. So if you could see, its enterprise value is less than the market capitalization itself. What does it tells you is that it is a cash rich company. Okay, so what does it tells you? It tells you that this company is cash rich. If the enterprise value is greater than market capitalization, then you can easily tell that it has excessive or more debt levels. Okay, so let's just quickly recap. Where were we? We were here. So enterprise value is calculated by market cap, adding the debt, and minus the cash. Why do we exclude the cash? Because it's an acquiring cost. The cash is that what you are getting in hand, and it reduces your own cost of acquiring the company. Right? Preferred share is I think I've covered it prior, but to quickly tell you, preferred share is issued by the company if the owner does not want to dilute its rights, its voting rights in a company, and it just tells to the shareholder that we will give you a fixed dividend on your investment. Okay, that is preferred shares, and preferred shares is actually added to the enterprise value because you are acquiring the complete company. The last one is the minority share. Let me just quickly tell you what it is. It's a bit tricky. So minority share. So minority share, or also called minority interest or non controlling interest. These are the three, these are equivalent. It's also known as, let's take an hypothetical example. Let's say you are calculating the enterprise value of company ABC, and it has a majority stake in company XYZ. Let's say 60% of company XYZ. Then you have to include rest of the 40% of the of net worth of XYZ in enterprise value calculation. I know it's a bit tricky. So how would you calculate net worth? It is nothing but total assets minus total liabilities. So 40% of this will be included in enterprise value calculation. So let's say if the net worth is, let's say, 100, that's 100 rupees, of course, that's an hypothetical example. uh, so 40% of 100 is 40, is should be added in the enterprise value calculation. Okay, I hope you get it. It's a bit complicated, that's why I've covered it in the end. But it's just that you should know how are the various components. By the way, you do not need to do all of this. You can get it readily available on the screener website. Okay, do not need to calculate it, but you should know the components of the enterprise value. Okay, to make an informed decision. To tell you very simply again, if you have not understood it, we are only adding it because due to accounting standards, we have already included 100% of the EBITDA of the subsidiary in our calculation. So when we will be dividing by the EBITDA, we have included 100% of the EBITDA of our subsidiary company, which we actually didn't own it. We only own 60%, but due to accounting standard, we have to include 100%. Okay, don't ask me why. It's just a standard we follow. Okay, I hope you get it. So now you must be very much clear how to calculate the enterprise value. It's a takeover price. You have to pay this price to acquire the company. Okay, so I hope you like it. Thank you for watching and have a great day. Bye. See you later in the next video.
Disclaimer: the information provided is for educational and informational purposes only and should not be considered financial or investment advice. I am not a SEBI registered investment advisor or research analyst. Investing in stocks involves risk, including the potential loss of principal. Always conduct your own research and consult with a qualified financial advisor before making any investment decision. Past performance is not an indicative of future results, and all investment carry inherent uncertainties. The author and associated parties are not responsible for any financial losses resulting from the decision based on this information. This channel does not promote any form of guaranteed returns or insider tips. Always invest responsibly. Thank you.